Hi everyone, this is Paige Garvin from Jennifer Schaus and Associates. We are coming to you live today from Washington, D.C. Thank you for joining us in a sponsored content webinar. Our webinar is brought to you today by ELINT Capital. Before we get started, I'd like to remind everyone that the webinar is being recorded and the recording will be sent out within 24 hours. You can also find our 800 plus government contracting videos on our YouTube channel. They are all complimentary. And lastly, please post any questions in the question box in your control panel and not in the chat box. Today is ELINT's first webinar in their Managing Cash Flow in Federal Contracting series. We are joined by ELINT Capital founder and CEO Charlie Newmark and Chief Product and Technology Officer Josh Leffler, as well as Managing Director of Excalibur GovCon Capital, Eric Rabinovich, who will share their perspectives on why cash flow pressure remains one of the most common challenges facing federal contractors and what businesses can do to navigate it more effectively. With that, I'll turn it over to Charlie, Josh, and Eric to get us started.
Thank you, Paige, and thank you everyone for being here. I'm Charlie Race-Newmark, the founder and CEO of ELINT Capital. I thought it'd be helpful to share how this company was born, why I built it, and how we all got here. When I was growing up, my father owned a small auto parts store in Orange, New Jersey. And like most small business owners, he extended credit to mechanics in the neighborhood in the form of house accounts. So someone who needed like a can of oil or a spark plug, they'd say, put it on my tab to keep their business running. And obviously those accounts at that time, this is the late 70s, early 80s, they were based on trust and relationships, but they still created a serious cash flow challenge. And I remember hearing the conversations, or I should more like arguments at our kitchen table about customers who didn't pay the bill and the strain that it put on the business, and in turn the strain it put on my father and our family. So that experience stuck with me for most of my life. And later in life, because of that struggle that I grew up in, I became interested in trade credit and the whole role it plays and how cash flow works. And then something I discovered seeing backwards, which I'm sure you've all experienced, is small businesses are effectively acting as lenders by extending credit. But these traditional lenders and banks had all this money. And then I realized, well, the banks only give you money if you need it, if you don't need it. And if you need it, then you have a problem getting it. So, I couldn't find a lender to essentially back unsecured debt, which was to like mechanics and plumbers, like my father was. And then I learned about government contracts, and I learned the fact that, the government always pays. They just pay really, really slowly, and the underlying asset, which is the receivable from the government, is the strongest on the planet. So that insight became the foundation for ELINT Capital. And so I spent a little while assembling an absolutely exceptional team that includes former government contracting officers, SBA leaders, government professionals, finance professionals, technology experts. And while I am not the expert in government contracting, my team is. And I've learned a lot in the last few years sitting next to them all. So today, ELINT is more than a financing company. I want to make that clear, even though we're talking about cash flow and financing. What we've built is a technology platform that's actually designed to help government contractors win more contracts, execute those contracts more effectively, and maintain compliance, and also have the access to capital that they need to grow. An important part of this whole solution ecosystem is obviously the money, and that leads to our partnership with Excalibur Capital. From the beginning, our vision was not simply to create software or simply to provide financing. It was to connect the technology, the government contract intelligence, and capital into a single ecosystem for government contractors. And through our partnership with Excalibur, we're currently able to provide funding on contracts up to $20 million per contract. So unlike traditional lending, our approach focuses primarily on the strength of the awarded contract and the contract backlog, rather than your personal credit score or a balance sheet. So the banks obviously tend to look backwards at your balance sheet. We know that as a business, you're growing and you're looking forward, and you want to take on bigger contracts and more contracts. So our system allows smaller contracts to compete for larger opportunities, scale with more confidence and focus on execution without actually worrying about whether they have enough working capital to bridge that gap between performance and the slow government payment. So ultimately, that's why we're here. Our mission, I always say, is pretty simple. It's help government contractors grow by removing as many barriers as we can. So again, thanks for joining us today. I'm excited to introduce the rest of some of our team, who's going to walk you through the what we offer and how ELINT can help your organization grow. So I'll start with Josh Leffler, who built our technology platform. So any questions about technology, you want to steer them towards that guy.
Thanks, Charlie. Hi, everybody. Josh Leffler, Chief Product and Technology Officer here at ELINT. I've been in and around government contracting for almost 20 years now, and particularly at the really esoteric place where financing kind of meets technology that drives government contracting. So I've worked in the government with government contractors. I've worked as a government contractor. Over those 2 decades, I've been in banking, most recently financial technology over at Bloomberg. As Charlie said, I'm the lead driver, the lead force behind the platform that we have here at ELINT. Eric?
Yes, thanks, Josh. Hey, everybody. Eric Rabinovich. I'm Managing Director with Excalibur GovCon Capital, and we are the funding arm and partner with ELINT, and we're happy to be here to talk about what we're seeing in the market and to talk about some of the more challenging aspects of winning a contract and being a growing firm in this market. By way of background, very briefly, I am a former government contractor. Josh and I actually worked together at PricewaterhouseCoopers in their public sector practice and worked on a number of contracts supporting financial services oriented government agencies. So think SBA, FHFA, Fannie and Freddie, although technically those are governmental sponsored entities. But we do have experience being on that side of the table. And then I also was a contracting officer with the Food and Drug Administration for several years. And then Josh and I also worked together helping stand up Live Oak Bank's government contracting teams. So coming at it from the perspective of a lender and how does a lender underwrite a government contractor at a bank. And so we'll talk more about how funding can look in this context, but happy to be here and let's get into it. Okay, so I think one of the more common misconceptions for a lot of newcomers into the government contracting space or folks considering getting into the market is winning work can actually, and let's also assume for the sake of this conversation, we're talking about profitable contracts, right? There's margin built in. And the challenge is, even with that, you can win work and then not necessarily have capital ready to go to start mobilizing on a contract. And that's really the primary pain that ELINT Capital and Excalibur are trying to fix and to solve. And so we see this time and time again, where you're a small business, you win the work. Could be your first contract. If you're a newcomer, it could be a long-standing business who's been doing this for years, and maybe they've won a very large contract. And the existing backlog that is, again, profitable, generating a healthy margin, it's not enough to be able to cover those essential expenses that have to start getting incurred as soon as you mobilize. If you're talking about whether it's professional services or goods, often there's that gap where you have to start paying either for employees or subcontractors, could be products, raw materials, supplies. There's a delay between when you start incurring those costs and then once you're able to start invoicing and be able to start getting payments on that contract. And so we'll get into how our product works, but that's really that gap. That's the challenge that we serve to fix and to make an afterthought, so that you can focus on going out, winning new work, getting proposals out, and not having to worry about actually executing. As everyone knows, if you don't execute well, if there's performance issues, if the government starts to doubt your capabilities, there's a steep cost to that, right? You could potentially have a contract terminated for default. You might have to deal with a cure notice. These are things, that can impact your CPARs. You, of course, want to avoid that at all costs, because that can be the thing that prevents you from winning any new work. And I don't think anyone wants that to be the result of actually what is and should be great news, which is winning work. But that's what we see if folks don't have that access to capital piece ironed out, and if they don't prepare for it ahead of time. So let's go through an example. So generally speaking, I know there could be some exceptions to this. There's contingencies on, what kind of contract are we talking about? What, is it a good? Is it a service? But generally speaking, just to go through what that cycle can look like. So of course, let's just start the clock winning a contract. So of course, you get notified by the contractor, contracting officer, and the award team. And depending on the timing, you're going to have to start figuring out how to start covering costs. And again, this can vary from newcomers to the market, whether it's your first contract, could be an existing long-standing member or a GovCon member who you've won your next contract, and now you have to start covering these costs. So usually it's those first 4 weeks that are the most critical. This is when you have to start getting folks, staffed, onboarded, getting payroll set up for everybody. And if you're thinking about a 1 month time frame, 4 weeks, most companies we work with, we see about anywhere from a monthly payroll to a bi-weekly. Those are the two most common the timelines we see for processing payroll. So if it's every 2 weeks, you're going to have 2 payroll cycles, assuming you're not able to invoice for 1 month. And then after that, you send the invoice in, and maybe the government's trying to cover a net 30 payment term in terms of approving that invoice, setting it up the chain at their local financing, whoever the finance office is within the agency, depending on the customer. I mean, obviously different names for different offices, but generally this is what the process looks like, whether we're talking about a contract at the Department of War, at the Food and Drug Administration, under HHS, where I used to work. This is generally going to mirror this process, no matter who the agency is. And so if you have to cover 2 payroll cycles, and then you're starting month 2, you're able to invoice for month 1. If it doesn't get processed and paid for another 30 days, you now have 2 months of payroll cycle. So 4 payroll cycles before you actually might start getting the first dollar of revenue on that contract. And that 60 days is critical, right? That's when you have to start. You want and have to start well to keep the customer happy, to make sure you're going to be able to get a good CPARs rating and be able to hopefully win new work with the government, because now you're a trusted vendor and you want to leave that first impression as positive as possible. So this is a common issue. There are cases, I know there's exceptions. There's cases where certain agencies are really good about the prompt payment compliance, and they can get invoices processed in 2 weeks or less. I mean, that does happen. Of course, everyone wants to see that. I think from our standpoint, and Josh, feel free to weigh in, that's more of an exception than the rule. And I wish it were different, because it would mean government contractors could have to worry a lot less about the access to capital, but it's a rampant issue. And so it's not, for me, it's not common. And so that, again, this is what we're trying to solve in the marketplace.
And I think just to add to that, Eric, you mentioned 2 weeks is rare but possible, but also 60 and 90 days is also possible on the back end. So there's, you mentioned a 30-day payment after invoice is submitted, but that payment could come in 60 and 90, which we've seen, which could really put you out for 6-10 payroll cycles plus materials and everything else.
Yeah, exactly. Well said, Charlie. And these might be edge cases, but to your point, there's instances where what we think of as small issues, maybe there's a typo on the invoice, maybe it was sent to someone who was out of the office. Small things like that can very quickly compound into significant delays. In some cases, you have to correct the invoice and send it in, and then maybe that 30-day or 60-day clock restarts. Sometimes you have to really get, and this doesn't go away if you have access to capital. You still want to get paid, and you want the invoice to be processed as fast as possible. But it puts small business government contractors in an awkward place if they have to really escalate and go to the government and start. You don't want to alienate your customer by demanding that they pay your invoice, but you also want to get paid for the work you've rendered and that your team has delivered. And so there is a added stress where if you're having to contend with the government's slowness and tardiness in processing these, it can strain that relationship. And so just having that access to capital, of course, while you still have to collapse those receivables, it doesn't make it maybe as stressful, and at least gives you a facility to be able to continue to manage that gap and the gap in timing between incurring expenses and being able to get paid. So,
and Eric, if I can just jump in here, just very quickly, that's part of the reason why we created the unique financial product that we did, right? It's created for government contractors by government contractors, designed specifically around the timeline that we see here. Because as Charlie said in his opening comments, we've lived it, we've breathed it from every angle. We know the government always pays, they just don't pay quickly. So it's hard to find financial vehicles that are affordable, that will allow you to grow with your government contracts. And we can talk a little bit more about it in more detail later, but that's exactly what we've done here. And anyone who wants to have a conversation about that in the audience, please ask a question about it, reach out to any of us. We're here to talk. So, yeah.
Okay, I think we can go to the next slide. So just to dive a little deeper in terms of some of the different examples of costs that are likely to come up. And again, this is going to be a function of the type of contract, who's the customer. Of course, if you're doing work with the Army, it'll likely be different goods and services that are being purchased by the Army compared to someone like or an agency like CMS, that Department of Health and Human Services. But generally speaking, most commonly, these are the types of expenses that need to get covered in those first 1 to 2 months. In terms of the gap, right? Of course, those expenses, if it's a services contract, will continue. But once you get into that rhythm of actually being able to start getting receivables and actually paying your staff, paying subcontractors, that's the point everyone's striving to get to. But those first, again, usually 6 to 8 weeks, 1 to 2 months, it's that critical period where you want to ensure you're starting that work on the most positive foot you can, and leaving a great first impression, or continuing to keep the customer happy if it's a subsequent contract and maybe your presence is growing within a particular agency. So payroll, I would say, is at the top of the list if we're talking about services contracts. Materials, is, of course, if it's a goods, services, and you need to order, depending on the payment terms you might be given by your vendor or vendors. If you're new with them, if you're a new client, you might have no payment terms with them. They might want essentially cash on delivery. So this is something where timing can play a big factor in what payment terms you get. And of course, that has implications into what your financing needs may be. So good news is if you continue to do good work and you're, of course, able to consistently pay your vendors, eventually they should be able to start offering some terms, and that'll help reduce some of the burden on relying on financing. But of course, to Charlie's point earlier, you're going to want it, because if you're going to win contracts, you're going to need it. And to have it but not need it is going to be infinitely better than needing it and not having it. In this case, it being the financing facility to be able to bridge those gaps between incurring costs and receiving payment from your customers. So subcontractors, of course, is another example here. And again, depending on your payment terms, that will play a role in what you might have to finance. Bonding and compliance. Bonding is typically, on A&E construction type of contracts. And then, vendor and overhead pressure. I mean, there's the fact that even if it's not billable staff, when you're growing, you're likely going to grow your overhead cost envelope with the business, right? So as you have more staff doing billable client work, you're managing a larger book of contract backlog, you're likely going to have to hire more bookkeepers, more controllers, more sales reps, et cetera. And that's overhead too. And that that's partially baked into all of the contracts that you're performing on. So all of these things play a role.
And just to add, you mentioned bonding and compliance. I wanted to mention that our finance, and we've spoken with several bonding companies, if you couple this particular type of line of credit with and you have a bond, you can actually increase your bond capacity because they're looking at your available cash. So when they see that you have essentially a financial partner with ELINT Capital, where we're funding and fueling your operation, we've seen where the bonding capacity can increase with that, which can then in turn allow you to take on more and larger jobs.
Yeah, thanks for adding that. I wanted to bring that up and stress how going to my earlier point about making a great first impression, one of the things that can happen in the intervening time from when you're being selected as the awardee until the work actually starting, there are on some of these contracts, and construction is one of them, if there's certain licenses or in this case bonding you need to get and you didn't think about that ahead of time, I have seen cases where you assume you're going to be able to increase your insurance coverages, get bonding, and sometimes you run into friction there. And to Charlie's point, the access to capital, showing you have sufficient liquidity or access to enough liquidity to be able to meet those requirements is critical. And I've seen cases that might sound like a chicken and an egg scenario, but if they don't have that capacity, that financing, then you might not get that additional level of bonding. So, keeping the awards you've been awarded is obviously a critical, priority for everybody. So this is probably nothing new for folks who are in the industry and have been doing this for years, but for newcomers, I know there's been a lot of renewed interest in the government contracting market. There's, of course, huge initiatives right now within the contracting and acquisition space to streamline how the government is able to purchase goods and services and to open it up and be basically easier for the government to get contracts in place. I know there's been a lot of newcomers to the market trying to participate in that upside, and this is important for them to understand. All right. This, I think we've covered the concepts here, but I mean, reiterating the fact that growing is expensive. Growing is difficult because it forces you to have to address challenges you may not have encountered before. And I think some folks have probably heard some variation of what got you here won't get you there. And this, I think, is a really critical example of that. You know, as you grow, the way that you may have bootstrapped and gotten to the point you are today, it's not necessarily going to work in a high growth environment. Maybe the line of credit you had that worked for the last couple of years, you've outgrown it. And you might be running into challenges with lenders in terms of increasing that line or getting additional debt. These are important things to anticipate as a firm grows so that they can be proactive and work to get some of this figured out ahead of time so they're ready to roll and ready to address those challenges head on once they start winning new work. So just focusing a bit on the IT contracting space, professional service space, it's similar to the themes we've been chatting about, but obviously payroll, talent, this is the biggest thing. And you want to keep your talent happy. You want to be able to provide them opportunities. Making sure they're paid on time is a pretty important component as part of that. And subcontractors, sometimes it might not be clear to the government, you know, who's a sub, who's an employee of the prime, but at the end of the day, you need to ensure everyone's being paid, right? So without that in place, you know, you're going to run into challenges on the work very quickly. Being able to hire fast and recruit, I think this ties directly into that. Being able to back up if you're competing with other space and trying to hire folks and recruit, you need to be able to provide a compelling reason for them to work for you. And so, you know, you want to be able to deliver on the promises that you're putting out there when you're recruiting and when you're trying to source for a particular contract. And again, we talked about licenses and some of the compliance costs, whether it's for a facility clearance, whether it's a certain certification. I will say right now, as everyone knows, CMMC is a huge topic, and there's costs associated depending on what level of certification someone needs to get. I mean, there's significant costs associated with having to go get and then be able to pass an audit and to pay the vendors out there who are providing that service. Sometimes folks get sticker shock at what it actually costs to be able to get certified and become compliant to perform on certain contracts. So that's another example of just, you really want to make sure you're able to cover those costs so you can actually perform on the work. That's critical. Unless Charlie, unless you guys had anything you wanted to add, we can move on.
Oh, I think unless Josh.
All right, so let's talk a little bit about some of the alternatives out there. What are some of the options for dealing with this issue we've been talking about today? What are the different products out there? Who sells those products? What are the pros and cons? So let's talk about lines of credit. This can be your traditional bank financing. Sometimes we see on here SBA loans as a separate bucket. Lines of credit can be delivered in the form of an SBA loan. There's the SBA Express line of credit. The general downside or challenge with both of these, both traditional lines of credit, SBA loans, I'll also throw in, if we're talking about a bank line of credit, we could also be talking about asset-based lines of credit where you're able to borrow against accounts receivables, inventory, works in progress, raw materials. So the challenge with that is you need to have assets first. You need to have an invoice issued if you're going to borrow against an invoice. You need to have inventory on the balance sheet if you're going to borrow against that. And in a lot of instances, especially if it's a services contract, you don't have any of that yet. In the time frame we're focused on, If it's the first month or two and you're hiring, you're onboarding, you're paying for certain compliance items that need to be completed to be able to start performing, if all of those costs are being incurred in those first 30 days, but you haven't yet been able to invoice, well, an asset-based line of credit in that scenario won't be of much help. Maybe you do have some inventory, or perhaps there could be accounts receivables from other contracts that you have and that you might be performing on. But if you already have a line of credit in place and you're already borrowing against those, then that might prevent you from tapping into any value. So that's the challenge with an ABL facility, with that type of line of credit. With an SBA loan or an SBA Express line of credit, the challenge with that is the way that those products are underwritten. If you look at the rules that the SBA imposes on all of the banks who participate in the SBA program, namely the 7A program is what I'm referring to, you have to look backwards at the applicant to see if they generate enough cash flow to cover the debt. It's by design, it is a cash flow based lending program. And you can maybe see where I'm going with this, but if you historically don't have enough cash flow to cover the additional debt you may need to get that SBA loan, then you likely won't be approved for an SBA loan. Now, I will say there are lenders out there who may be able to get comfortable on a projections basis. But if you're looking for an SBA facility on a projections basis, I do want to share that it becomes a lot harder to find a lender who would actually get comfortable with that. It's not impossible, but it drastically reduces the number of interested lenders and lenders who would actually approve you for a loan. And so it's that is the challenge with that angle. It can happen, but it's tough. And more often than not, banks will just say, we're not able to get comfortable, come back in a year or two after you've already proven that the business can perform. And like Charlie said earlier, essentially proving the point, they don't give you cash when you need it. They offer it to you when you don't need it. So that's the main challenge with SBA debt, with 7A debt. Invoice factoring, a lot of what I said about the asset-based lines of credit, it's true for invoice factoring as well. I would say the additional challenge is that it's also very expensive. So invoice factoring, most commonly, as far as how we see it in the marketplace, and again, there's different lenders who offer factoring and different products and pricing, but generally what we see is a factoring company will offer 90% of the face value of the invoice, assuming it's a prime contract, and they will get 100% of that payment once it comes in. So you're essentially paying 10%, independent of however long or short of a time frame it takes to get paid. And so if you do the math, if you're paying 10% of that invoice value, and it takes, let's say, 60 days to get paid once you submit a valid and proper invoice. Well, the effective APR on that is essentially 60%, which is a very high cost to pay for what we're talking about here. Obviously, it's important. You need access to capital. It can be an option if you have no other options, but cost is a major component. There's no point in winning a government contract and then having to perform on it only to essentially wipe out the vast majority of your margin, or in some cases all of your margin if it's a really competitive contract. I don't think that's anyone's goal for why you go into business or why you want to sell to the federal government. And then, of course, vendor payment terms, like I said earlier, generally, if it's a new vendor, they're not going to offer you any payment terms. I think over time, once you've shown that you're reliable, you pay, you can perform, you're creditworthy, then they will offer credit. And that can be anywhere from 30 to 90 days is typically what we see, depending on the vendor. There's one other point I want to make here too, which this comes up actually quite a bit with acquisition scenarios, where if you've bought a business one of the more common things that get overlooked is the payment terms that might be in place with the vendors that the seller was doing business with, and that you will do business with as well as the new owner. But if you, even if it's a stock sale, I will say usually with a stock sale, it's more likely you can preserve payment terms. But even then, there's usually terms and conditions that require the vendor to be notified that ownership has changed. And what I've seen more often than not is terms get renegotiated, and sometimes it starts at zero. That vendor doesn't know the new owner of the business, and so they'll restart at zero to show that, okay, you're essentially a new vendor, or a new customer for us. And I've seen that in acquisition scenarios. So this can come up unexpectedly for a new business owner. If you've bought someone's contracts or an asset, if it was an asset sale, this is another thing where, without even realizing it, you have this new cost because previously you were able to leverage that, the payment terms. And now, if that goes beyond what access to capital you have, now all of a sudden you have this crunch again that we're talking about. So.
Yeah, I want to build on Eric. So you see here, like banks line of credit, SBA loans, invoice factoring, vendor payments. I think a great way that we found to describe our product to people is it's like a combination, right? But it's really like a credit card in the way that it acts. So we looked at, we've had a lot of conversations around what does a small business need to grow? A credit card. What's the problem with a credit card? High interest rates, low limits, right? They'll give you enough, but not really enough. And I don't know if you could pay, payroll, a couple $100,000 payroll with a credit card. So our product really functions like a credit card, not credit card rates and not credit card limits. Again, like I said, with our partnership with Excalibur, we could do lines for each contract up to $20 million. So think of it like a credit card flexibility. You don't need to have an invoice with a credit card. You could get the things you need. You could pay for the things you need in real time. And then just like that, I did want to mention how our repayment terms work, which is exactly like a credit card. So government pays, you'll receive a statement, and that statement allows you to pay the minimum payment, which is the interest and the fees due for that cycle, or carry a balance if you want, or pay down some of the balance. So you're really in control of that cash flow. And just like a credit card, I know some of you have done, if some of you have done credit with banks, we don't require any reporting, just like your credit card doesn't require reporting. So I know that's a pain point for a lot of businesses, which at the end of the month, they have to come up with all these documents and everything. Josh has built our technology around being able to have insights into your financial health, so we don't need to get those documents. So that's why I mentioned it's really like a credit card in the flexibility.
Well, that's a great segue, I think, just to talking through what does reasonably structured and reasonably priced financing look like? What actually serves the needs of GovCon firms who are in the circumstances we're talking through and describing on today's webinar, and really we can go into a little bit more detail on what the product that we offer looks like, how does it work. And so what we think is, whether or not you've invoiced the government, it's not a controversial statement to say you have to be able to cover your expenses. Putting aside how you do that, whether it's one of those four, the four general categories we just went through, or with a government contracting mobilization facility that we offer, the fact remains you have to cover your costs, your payroll, your subs, your supplies, etc. So being able to cover those costs and having the confidence you're going to be able to, upon award, that's where we start. And that's what we think that contractors deserve who are doing business in this space. So being able to submit and get payment, be able to cover your costs at mobilization before you've made generated an invoice, that's what we think makes sense. We think liquidity that allows you to grow with confidence, knowing that as that backlog increases, as that cost structure increases with the growth, having the confidence and peace of mind that you're going to have access to a facility that's designed to be able to grow with you, we think that that's important. Having a relatively streamlined disbursement infrastructure is critical. We want there to be as little friction as possible from the moment you realize I need a draw to cover these expenses until the moment that those funds hit the account of your vendor or of your payroll provider. We think that's critical. That's really important, because if you're not able to streamline how you access your capital, then what's the point of all this? So Charlie mentioned it works similar to a credit card. This isn't an actual credit card, right? We are more similar in how we process draws to a bill pay feature that a lot of banks offer, but it is streamlined in that you'll add a vendor once, we'll underwrite them, we'll onboard them, and then moving forward, it's very easy to request draws to pay those approved and onboarded vendors. And again, you go through that process once per vendor. We do have to go through some KYC verification, but once someone has been onboarded, it's quite easy and streamlined to pay them in the future. You don't have to keep requesting draws and sending that documentation in over and over every time.
And go ahead. I was going to say, one of the unique features that you hit on, which is, it's designed to grow with you. Unlike a bank or any other types of credit lines, as you win more contracts, your credit line with us can increase pretty simply. It's not a whole underwriting process. We already know who you are. We see the contract backlog. So if you're working a $2 million contract and then you win a $5 million contract and you need more capital, we can easily increase that capital that's available to you.
The one other thing to add on this point for the disbursement infrastructure as well is, we talked a little bit about asset-based lines of credit or invoice factoring. For anyone who's not familiar with asset-based lines, or if they are familiar, they're probably all too familiar with the fact that there's onerous reporting requirements that can come into play as well. So with an asset-based line of credit, generally speaking, in order to get a draw against your asset base, you have to prepare a borrowing base certificate, and then different lenders have different processes for how you go about doing that, ranging from semi-automatic to very, very manual and time-consuming and frequent. If you have to submit that every draw, every week, every month, that can be another requirement or hidden cost on top of the already challenging structure or high price you might be paying for the debt in the first place. So just something else to consider. We don't require borrowing base certificates. We try to streamline the reporting and the ability to be able to track your receivables. We want it, as I said earlier, to be as streamlined and frictionless as possible. And that's how we designed the product to work. And the last couple of points, right, this is designed to specifically address that gap that we talked about. And it's highly flexible. You don't have to pay it. It's not all or nothing, right? If you only need it for, it is a line of credit. So if you're only paying interest on the balance that you carry. So if you only need it for a few months, whatever period of time it is, you're going to accrue the interest. And then as the money gets paid down and the line comes down, as it does with a revolver, you wouldn't have any interest payments if you don't carry a balance forward, generally speaking. So it's meant to be used when you need it and not cost you an arm and a leg when you don't need it. So lastly, we structured this from the perspective of actually being government contractors, contracting officers, and lenders who operate in the government contracting markets. So it's purpose built for this industry. So I think with that being said, we are going to turn it over to questions and would love to hear from folks if there's anything they want to know more about, how it works. any questions at all. I think Josh mentioned earlier as well, if there's something really unique or specific to your circumstances, we're more than happy. We'd love to connect afterward, find some time on the calendar and just walk through what things look like for someone if they're thinking about this or want to learn more. So happy to go through folks' individual circumstances and unique scenarios after this. But if there's any general calls or questions that we can go through, we'd love to hear them right now.
And one quick thing too, to build on that, which is elintcapital.com, which you could see right now on your page. If you go there, we have a unique little widget feature that Josh built, which is you can enter your UEI into that system and it'll pull back in about 5 seconds exactly what you can qualify for today. And that's based on it's going in, reading your actual contract backlog, and then coming back with an estimate of how much you can qualify for. And I could say with confidence, because I've spoken to a lot of contractors, people are usually quite pleased and shocked at what they qualify for, because it's not looking at your credit score or your balance sheet, it's looking at your contract backlog. And I'll leave it at that and then open it up to questions.
We do have a couple of questions that have come in. The first one is there a minimum contract size or revenue level that you typically work with?
I could take that if you want. No, I would say that the limit currently where we're at is 20 million, but I will build on what Eric and Josh have mentioned, which is if you have a unique scenario, let's say you have a $30 million contract, don't rule us out. We can maybe get creative in fulfilling that. And as far as minimums go, I would say no. I'd say probably, we could do loans as little as $200,000. I don't think we've seen much less than that. Our sweet spot, I think, is about $1 million to $3 million, but again, that's only what we've seen in the market, and 20 million is the cap. So, and also, listen, if you have a small contract and you need the money, don't rule us out as a solution. Let's talk, because if we can't work with you on this particular contract, maybe there's an opportunity to work with you on a future contract.
Awesome. Another question. Can you reiterate how the repayment process works? As in, we, the company, still receive the direct payment from the agency and then just pay down the debt based on the statements that you provide?
No, actually, so the payment, part of our closing agreements, right, is we disperse the payments on your behalf, on the company's behalf, like Eric had mentioned, which is you come to our platform, there's a drop-down menu, it has all your vendors there. So let's say it's ADP or Gray Bar Electric or whoever it is that you're paying. You drop down the menu, you click on your vendor, you select the amount you want to be paid out. We disperse that payment on your behalf, and then all payments from the government or the treasury come into our account. And then the day that money lands, you'll receive a statement essentially asking you, like I mentioned earlier, what you want to do with that money. Do you want to pay, here's your minimum. We received, $200,000 from the government. Your minimum payment is $10,000. You want to pay just the minimum? Do you want to pay the minimum plus some principal? And then you can also set parameters where you don't have to answer that every time. You could just say, pay the minimum every time, or pay the minimum plus 50,000, whatever you want. And then as soon as we get that answer from you, we disperse the funds directly into your account. Usually within 24 hours of them landing in our account, they'll land in your account.
Next question. What does the application underwriting process look like? You mentioned that you don't require borrowing certificates. What is actually required?
Eric?
Yeah, I can take that one. So we'll want to have an initial conversation to understand the nature of the business, what's the product or service that you offer, who are the target customers, are these prime contracts, subcontracts. I will say we can lend in its case by case. We primarily are orienting around prime contractors, but we can in some cases lend against subcontracts. We would have to see who the prime was, but generally we'll have that initial conversation, and then we'll send a document request list where we'll want to get an idea of what contracts do you have, what are you performing on, who are the customers, dollar values, level funding levels in terms of obligated dollars, how much has been billed so far, how much is remaining. So there's some financial documentation we'll ask for oriented around that, but it's fairly slim compared to a traditional bank underwriting process. We're getting similar information, but not nearly as much, and therefore we can generally move a lot faster than a bank would have to. And so the way that we approach it is it's fairly streamlined. We're also working, and it's getting better every day, but we have what I think is a very impressive technology platform that takes a lot of the friction out of the process in terms of being able to apply, being able to submit documents, being able to message efficiently with the underwriting and servicing teams as you move your way from the application process into approval and funding and then servicing moving forward. But the first step would be, I would say, let's have a phone call, let's have a conversation, let's learn more about one another and see if it's a good fit. And then we can actually, send the doc request over and start with the formal application process. Our goal is to be able to underwrite, assuming a complete package. Our goal is to be able to underwrite, close, or approve, close, and fund within 30 days. And we generally can stay to that timeline, so we can move fairly fast. In some cases, it's faster than that, but that's our goal. And yeah, I'll stop there.
The next question, how fast can funds be dispersed to vendors? If I'm submitting a payment, how quickly can that go to my vendor?
So I do want to make a distinction between what I just mentioned in terms of approval and getting funded versus once the facility is up and running, getting the draws processed is typically a day or less. So we have a wire cutoff generally at 3 p.m. So as long as we're able to get what we need, and depending on the time that the draw request is submitted on a given day, we can often process it same day and get it out. Usually if it's later in the day or close to the cutoff, it would get processed and sent out the next day. But generally 24 hours or less is the turnaround time.
Next question, how does this work for a contract that's already underway? If we already have an active contract, can we still get funding, or is it only at award that we can do that?
Yeah, good question. No, this is not only available for new contracts. Having an existing contract, being in the middle of a period of performance, being in option year 2 or 3 of 5, that's all fine. That's all that would count towards any applicant's borrowing level or capability in terms of how we calculate how much we would lend. That's all. That's all allowed. There's no strict limitation to just new contracts. However, what I will say is if someone has an existing debt facility in place, that could have implications around how we move forward. Generally speaking, we don't lend in, we're not a mezzanine lender. So if there's a priority lien on, an SBA lender, what we'll try to do in those cases is get a carve out for the AR and inventory. And if we can get comfortable with that, we've seen cases, this comes up to with idle loans. If someone has one of the emergency SBA loans that were made available during COVID, we're often able to get a carve out there. So that can create challenges, but the contract itself does not need to be new. It's totally fine if it's, the middle of the period of performance or one of the option years.
All right, and the last question so far, do you work with subcontractors?
We do. Yep, we do work with subs. It's two things. One is it's case by case. We'll just have to take a closer look and see if we can get comfortable. And then the other thing I will say for subcontracts is the effective borrowing capacity, all things equal, will be lower for a sub compared to a prime. So we do lend a little less on a particular subcontract, even if it's the same contract value. That's just to reflect what is a slightly elevated risk profile for subcontracts, because subcontractors don't have that privity of contract directly with the federal government. But again, case by case, we can and do get comfortable with subcontracts.
All right, that's it for questions.
Okay, wonderful.
Great. Well, thank you everyone for joining us today. And again, feel free to reach out, either email, phone, or check out the website and put your UEI in, and that's also a great place to start. But we're always open to conversations. So if you think that we might be able to be helpful, don't hesitate.
Yeah, thank you, everybody.
Thank you again for joining us, and thanks, ELINT, for a great presentation.
All right, have a great day.